and talk a little bit about kind of the cult of personality that's come along with alternative investments sometimes in its past. I want to mention guys like Carl Icahn in the 70s and 80s and guys like Bill Ackman today. How much of what's being said in sound bites for 3 minutes on CNBC is moving the alternative investments market? And how does that influence kind of what you guys are doing in the back office role? Even though you're a figurehead for Waterloo, you also maintain a back office role at some level. Can you talk a little bit about how that moves the markets or how that influences the way that you make decisions on a daily?
Yeah. So let's be clear, in the hedge fund space, one strategy within, the hedge fund strategy buckets is activist investors. And it's the idea that a manager can take a position in a stock and then go public and speak their book. Carl Icahn's done this. Bill Ackman has absolutely done this. So they'll build in a position and they'll go to the public and say, oh, well, we think that, Herbalife, for instance, is, a fraud. They're a Ponzi scheme. So, we have a short position on it and we're going to tell you why we have that short position. And it absolutely moves the market. Now, whether or not, the compliance around, what can be said and all that gets a little complicated. So we won't go too in depth on that side, but the cult of personality is alive and well in the hedge fund space. These managers are calculated and know exactly what they need to say to move a position in their book. And that's what they're, the investors that invest in those funds pay them for. We've always had more of a focus, especially in the hedge fund side, of really trying to create diversified, uncorrelated strategies in that space. That's just kind of our philosophy when it comes to hedge fund investments. And we've kind of steered away from some of the, more verbose activist managers.
Is that mostly from a diversification perspective or a liquidity perspective, or is that a risk management?
It's risk management primarily for us because, a lot of these strategies are taking really concentrated positions in individual stocks and levering the fund against those positions. And so, the individual client, it's probably a lot of times maybe not appropriate for that level of risk that you might be taking in a fund like that, to where, you kind of look at, some of the large funds like Ackman's Pershing Square Fund. I think they had a great year last year. I think they were up, 20 to 30%. In previous years, they were down 20 to 30%. That sort of volatility might not be appropriate for an individual investor that, are really trying to, invest with, a shorter time horizon than you think about a perpetual institutional allocator. So, risk management is important. And, additionally, we're investing in manager skill in the alternative space. And, for us, we really try to incorporate a lot of these strategies into a diversified portfolio to allow our clients to earn higher risk-adjusted return and meet their objective, ideally with less risk over time. And that's how we think about the alternative space.
Sure. And as you vet those managers or those funds or those tools within the space, what is an appropriate timeline in your mind from a vetting perspective? How long do you look back, and what do you look at, when you're evaluating as someone who's bringing it to the masses, so to speak?
Sure. So our process really kind of starts on idea formation. So we do a lot of research. We publish a lot of research here at Waterloo. We just released our annual outlook. But we try to find certain areas of the market that we want exposure to. So over the last few years, we've been really active in private credit and direct lending, just kind of based on our bearish view of public bonds and, our anticipation of higher interest rates. And so, our thesis there was, okay, let's try to find, investments in private credit that might have a floating rate component, be backed by hard asset collateral, to where if we get a pop in interest rates, we're not going to be as affected from a valuation perspective. So like last year, public bonds were down. I think the aggregate bond index was down 13%. A lot of our, private credit strategies were up, 7 to 12%. That sort of outperformance, really kind of starts with, creating a thesis. So that's number one. Number two, we'll go out and, look across the market and try to evaluate, all right, what managers are implementing this strategy better than others. We have a few different ways that we can do that from a quantitative and qualitative perspective. We have initial meetings, we have conversations, we get access to data rooms. We'll go through and spend a lot of times 6 months getting comfortable with a manager.
Sure.
And then once we've gotten to the point, narrowed down our funnel to maybe 1 or 3 managers in a space, we'll go ahead and do a full due diligence. We'll go to the manager's office, really try to understand their strategy, back office operations. There's 2 different types of due diligence when you're thinking about private markets. You have your investment level due diligence, where you're trying to understand the strategy, looking at their track record, looking at the manager's background and their ability to replicate the strategy that they've implemented in the past. And secondly, there's operational due diligence that is just as important as investment level due diligence, to where we want to make sure the firm has the proper checks and procedures to administer the fund, protect client assets, and generally be able to execute the strategy from a business perspective.
Right.
And both of those are equally as important. And we spent a lot of time getting to understand exactly how these firms, how their business works. We'll write out our due diligence memorandum. We'll share that with our clients. And we spend a lot of time with our clients to really make sure they understand not only the firm that they're investing in, but the strategy, the managers, and how that fits in with their overall portfolio.